Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're on the watch for some Supreme Court rulings here today. We did get one. The U.S. Supreme Court upheld a 2017 tax on American-owned business foreign profits. Jin Grasso, Bloomberg legal analyst, joins us here in our studio. Not one of the real sexy ones, but
not even on the most watch list.
Not even on the most watch.
Maybe on Bloomberg's most watch
care?
list.
These are taxes,
well,
right?
Companies care, but the average American citizen who's looking for the hot button issues doesn't care about this. I mean, if they had not ruled this way, it would have sent the Internal Revenue Service into a frenzy trying to, restore taxes that were paid and also some of the, the rules that they have. So this basically was two people who owned a minority stake in an Indian company in India, and they said that they shouldn't have to pay the taxes that were allocated to them because they hadn't gotten any profits from the company. And, this is the 16th Amendment, which I think law school was the last time I ever heard about the 16th Amendment. And so, the justice says this is no different than any other tax. And the fear was that this would enable a wealth tax if a wealth tax ever comes. And that was the only fear really from this case. So it's 7-2. That tells you that there wasn't much problem.
And what else are we waiting for? What are those hot button issues? Everything.
My gosh, well, first of all, we're waiting for the abortion case from Idaho about a state law that basically, makes it only possible to have an abortion if the life of the mother is in jeopardy. We're waiting for a gun rights case, which is based on the Second Amendment, which is whether there's a law, a federal law that people who have domestic violence, abuse charges against them, or who have the man in this case had a domestic violence temporary restraining order, can't have a gun. That's another one. There's the Texas and Florida social media cases, whether or not social media companies are allowed to look at what they have and pick from what they have and knock things off their platform. There's a case that will make people's eyes sort of glaze over, but it's really, really important. It involves something called Chevron deference. And this involves every agencies, whether or not you're going to give deference to an agency's interpretation of a law that's ambiguous, or whether the court should be the one to interpret it. And so several of the conservative justices have been trying to get rid of Chevron deference for years, and the question is whether or not, and it's something that conservatives have been trying to do because they don't like agency authority.
Because in part because of the EPA, right? Because the EPA has large latitude. I know it goes all across.
It's the EPA, it's banking, Social Security, you name it. This would anything involving an agency, this would affect. Okay. And I think the Labor Department is the department that has already started not relying on Chevron deference in proposing rules because they're afraid of what the Supreme Court may do here. I have to look up which it is, but I think it is the Labor Department.
Jin Grasso, Bloomberg legal analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We also want to get to some of that economic data that broke earlier today. New home construction in the U.S. slumped in May to the slowest pace in 4 years as higher for longer interest rates sapped the housing industry's momentum from earlier this year. Drew Redding, we pay him to do this stuff. He's a home builder analyst at Bloomberg Intelligence. Drew, what's happening in the home building business construction?
Yeah, so a pretty big miss on the headline today on the housing starts number. Not all that surprising. You have to remember rates went up to 7.5% last month, and they're still hovering at around 7%. We also had some weak data on the home builder confidence side. But these numbers are also being impacted by, you want to parse out what's happening in the single family side versus the multifamily side. And the way we tend to look at it is non-seasonally adjusted on a year-over-year basis. So we had total starts down 20%, which is a pretty big number. But single family starts were actually up 3% and multifamily is down 57%. So that's a lot of the story right there. And if you look year to date, total starts are down about 4%. Single families up 19, multifamilies down 40. So that dynamic is one thing at play. The other thing that we've talked about in the past is the relative advantage of the big, well-capitalized, publicly traded home builders. And we just had some data from Lennar, who just reported results, which lines up nicely with what we just got on housing starts. And if you look at over the last 6 months, their starts are up about 20% year over year. So, a couple stories. It's the single family side, and then it's the big public builders.
Well, what did we learn from KB Home on that front? Because that usually caters to sort of the entry-level buyer, Lennar more high-end.
Yeah, KB had great results pretty much across the board.
Okay.
Their results told us that demand remains strong, that buyers are still responding to the use of incentives. It also tells us that incentives probably aren't going away in the near term. When we came into the first quarter, there was an expectation that, hey, look, rates came down to 6 3/4. Maybe builders are going to be able to pull back on their use of incentives a little bit, and that would help margins in the back half of the year. But it looks like with rates back at 7, they're going to remain elevated, which will put a little bit of pressure on margin. So it's a demand versus margin story, and buyers are still responding to incentives.
Drew, kind of where are we in this country in terms of supply of housing? I know for a while the story had been we're at a deficit. There's not enough housing. Is that still the case?
Yeah, that's a great question. And, one of the main speaking points for the builders was there's nothing for sale on the existing home side. People don't want to list their homes because they don't want to trade in their rate. We're starting to see a little bit of a shift there. If you look across the country, inventories are up about 13% in the last month. That being said, if you take a step back, they're still down about 30% from pre-pandemic levels. But what's interesting is kind of what's happening across the U.S. And if you look at certain markets, you're starting to see, some warning signs. And, some of the ones that come to mind are Texas and Florida. In Florida, you've got inventories in some cases rising over 50%.
Wow.
And are actually above 2019 levels by 50 to 75%. A lot of that's concentrated in some of the west and southwest markets, but it's something certainly to keep an eye on because as that inventory increases, the advantage builders have had diminishes.
That's interesting. What are some of the other sort of hotspot areas? We had a great piece out talking about, was it Tennessee? Was it Tennessee that is attracting all the people from the West and East Coast and is sort of pricing out all of the people that actually live there? Like, how do big waves like this, like we saw in Texas, like we did see in Florida, how does that wind up affecting the housing market?
Yeah, there has been a lot of movement out of some of those high-cost markets, from coastal California, maybe inland, and then into markets like Las Vegas and Phoenix. What we're seeing from a demand perspective is kind of interesting. At the national level, demand in the new home market has been relatively strong across the board, but we have seen markets kind of move in cycles. So if you look at the hardest hit markets back in, the second half of 2022, when rates really shot up, you had, California, Washington, all the markets across the Southwest, those have actually come back pretty strong. And it's now some of the markets that were leading. You think about the Texases and the Floridas, which are the two largest markets, are now starting to soften a little bit from both a pricing and a sales perspective as inventories start to rise. So, those markets, big picture, are still benefiting from out migration into some of the lower cost markets. That's why you've seen the Southeast and Florida do so well. But at the same time, we are starting to see a little bit of a slowdown there.
A friend of mine just put her house on the market yesterday, and I told her, I don't even think you're going to get to your open house on Saturday. I think you're going to have like a gajillion offers come in.
And
you're going to get, so we'll see. I'll check in, but it's just one of the things, you just don't see existing inventory coming onto the market that much. And when it does, particularly in a pretty middle of the road price range, I got to think it's just going to be snapped up like crazy.
The 7% versus 6% interest rate doesn't matter as much anymore, is what you're saying.
Yeah. I don't know. We'll have to see. So, Drew, is there a sense that rates have to come down for existing homes to really move?
Well, I think you want to see rates get into that 6.5% at least to see things start to loosen up a little bit. But what's interesting, and Alix, you mentioned it, 6 versus 7. There's not a whole heck of a lot of difference there, and you have to remember the people coming to the market now are coming with that higher rate mindset versus what they were a couple of years ago. So people have certainly started to adjust. And at the same time, we're still transacting at these higher interest rate levels. So that mortgage rate lock-in effect that we've talked about previously, it starts to gradually loosen a little bit because you've had more buyers purchasing at higher rates.
All right, really great stuff. Drew, you're the best. We appreciate you. Drew Redding, he covers home building for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix, Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. I'm looking at a story here. Dell Technologies shares rose Thursday after Chief Executive Officer Michael Dell said the company is building a Dell AI factory for Elon Musk startup xAI alongside Nvidia Corp. A lot of big names in the first opening sentence there. Let's check in with Jin Ho. He covers all the tech stuff for Bloomberg Intelligence. Woj, what's going on here with Michael Dell?
Yeah, so Michael actually posted a Twitter post on some of his AI server racks that's going to go over to xAI, which is Elon Musk's AI startup. Elon Musk actually followed up and saying, hey, yeah, this is happening, but we're only going to split the deal with both Dell and Supermicro, and you're seeing Supermicro rise as well.
Can you just walk me through like what this all looks like? Like when I hear that headline, and they're going to provide servers for AI, X tech, whatever, Twitter, Musk thing. What is that?
Yeah, so essentially you need specialized servers to help build or help support large language models. If you think about the AI build out over at Meta or at Google, you need, hundreds, well, thousands of GPUs to help support it. And each of these server racks are going from roughly 100,000 per rack for a traditional server rack. And what I calculate is going to go to about $1 million per rack, all clustered together. So, we've published that this one deal could be upwards of $3 billion split two ways between Dell and Supermicro.
All right, I'm going to ask the Alix Steele question. As I'm looking at this photograph that was part of the Twitter spot for Mr. Dell, I see a big factory, lights, air conditioning, all that kind of stuff. I mean, how are they going to power all this stuff? Did they ever talk about that?
Oh, I love you asked this question.
Yeah. Well, look, Elon Musk. I've actually seen some of the layouts or where this AI factory may be going to, and they've actually allocated the power for that. Now, near term, I think the power needs should be fulfilled. You don't do the planning without the power. But longer term, I do think there might be some issues in terms of getting the land necessary, the data center land necessary to build out these AI data centers because of the amount of power that they're going to suck up. Some solutions may be small nuclear power plants set aside to these data centers, but there's some regulatory issues along with that.
Although I was reading that potentially something might be sent to President Biden today that would make it easier for nuclear. And I wonder if that's all sort of playing into the energy transition, but also the big data centers. So you said it could be worth as like $3 billion. So they enter into this agreement. When does like a Dell and Supermicro book that revenue? Like, does that show up on its order book?
Well, I wouldn't be surprised that's already in the backlog numbers.
Okay.
In their backlog numbers today. One of the things, the metric that I'll share with you is that Dell did $1.5 billion in AI server sales in calendar 2023. I have them going in around $7.6 billion in calendar 2024. Supermicro, they're probably on pace to about $18 billion in calendar 2024. What this is telling me is that not only are you getting more AI or larger AI server deals, but you're getting more AI server deals going forward. So
Dell, Supermicro, those are two ways to play. What else in your space kind of fits into that AI theme here?
Well, I mean, my colleague, Kunja Sobayani, he covers the chip space. Nvidia, everyone knows. Broadcom, which has rallied over the last few days. They are a leading AI chip player. On the networking space, Arista Networks is one of the vendors to know. There are some other guys, such as Cisco and HPE, but they'll be more enterprise focused, at least for the time being, and won't have as a sizable impact from AI on their numbers, at least in the near term.
So when I'm talking in panels and stuff, and I hear people like, okay, this is definitely a bubble. It will definitely burst. We don't know when and how and why. We definitely want to buy puts. Like, we're definitely in a bubble. We just don't know what that looks like. What do you, who are combing through the numbers, think?
Yeah, so we published our valuation note for Supermicro today, and I'll tell you, much of the stock rise over the last couple of days or the last year or so has been more earnings driven than anything else, and it goes back to the fact that a lot of these AI systems have this humongous ASP boost. I mentioned $100,000 a rack. The latest generation of Nvidia servers, they're going to be about $3 million per rack, and that's going to support their $25 billion in fiscal 2025 expectations. And I think that if you think about a housing boom, we are going through an AI housing boom right now, and this is going to last for the next couple of years. Now, when does this housing boom bust? Still too early to tell, because first it's going to be the cloud. The enterprise is going to start following. I don't know how big that enterprise opportunity is just yet.
Any sense there, Wooj, how much of this incremental AI spending is in fact incremental to overall tech spending, or is it just taking it from other buckets?
Yeah, that's a good question. And if we look at the companies or the sectors from a sector basis, within hardware, we've seen some of the traditional hardware lag in terms of spending. I do blame some of the declines in traditional hardware spending to a mix shift to AI. But the other thesis that's going around right now in the investment circles is that, it could also mean that they're going to spend less on software as well, right? So from a larger perspective, there might be spending that's being pulled away from software to build out the infrastructure. Over time, as more software becomes AI enabled, the investments are going to flow back to software.
So the whole thing with Nvidia, like trying to talk about software and not hardware as much, what is that?
Oh yeah, so there actually is Nvidia is also a software name, right? You actually need to build code to drive the GPU chips very efficiently, right? And the bigger the developer user base, right? Think about it as a programmer for Microsoft or a programmer for Oracle, right? You're trying to build this big developer user base so you can have your AI programmers to write to the NVIDIA chipset, right? There's two benefits to this. One, the AI chipsets try to leverage the software to optimize the energy consumption. So there is an energy benefit to this. And also, two, you're trying to lock up more developers to write to the NVIDIA GPU so you can gain or grow your market share in the GPU space.
All right, we're seeing more and more ways to play AI. I mean, there's the chips, there's the hardware, the software.
I don't know how would you keep it all straight. I got to be honest.
He's a smart guy. Jin Ho, thanks so much for joining us. Jin Ho, he's a senior technology analyst at Bloomberg Intelligence. He's down in our Princeton, New Jersey office here, giving us some more views on how various companies within the tech stack, as the tech geeks say, in this case, Dell Computer, Supermicro, stocks moving today on more servers being installed for the folks that are going to be running these big models, I guess. So.
And it just goes again, and then you pair that with those that just watch momentum and bubbles, and they get increasingly worried. Right. So it's really hard to square those two at the end of the day.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. All right, here's a story getting a lot of readership today about McDonald's. McDonald's U.S. chief says the company is ready for a fight, and in order to win, the burger chain is pulling out one of the most potent weapons in its arsenal, the value meal. So they're going to be putting some chicken and you get fries and you get a Coke, all for $5. That's pretty darn solid. But what does it mean for the restaurant companies? So let's check in with Mike Halen. Michael Halen, he covers the restaurant industry for Bloomberg Intelligence. Mike, I guess, the big guns here for McDonald's here, the value meal. What's going on in the fast food business these days?
Yeah, listen, they have scale. They have scale that allows them to offer prices that some of their competitors can't match, right? And so, what we're seeing now is consistent traffic declines. Same-store sales have been pretty weak now for about a year in the restaurant industry. A lot of that is due to low-income consumers. Darden, on their earnings call today, said it's 75 households with 75,000 or less in income, and the customers that are really struggling are $50,000 make $50,000 a year or less. So, we're still seeing this K-shaped recovery. And so, about a third of McDonald's business is that low-income consumer. The traffic declines can be mostly attributable to those customers visiting less frequently. There's been a lot of bad press about McDonald's and some of these other fast food chains and how much they charge. They went viral because one of their stores were charging $18 for a Big Mac meal, right? And they want to kind of level set people's expectations about what they're going to pay inside the McDonald's and kind of get people focused back on the fact that, you can still get a lot of value on that McDonald's menu.
Do they still have a dollar menu?
$5 meal yeah, it's the $1, $2, $3 menu. There's not many items for $1, if any. I think everything's at least $1 and change right now. But the timing, the timing makes sense. Last month, casual dining chains actually outperformed quick service same-store sales for the first time since last January. And I think a lot of that has been this bad press about how much quick service chains are charging. And chains like, Chili's have been kind of playing into this. They're saying, look, we have a $10.99 3 for me deal. You get a lot more food, you get a better burger, and it's cheaper than a Big Mac meal. So McDonald's is trying to turn the tide again here.
Looking at the FA function for McDonald's, I mean, they got gross profit margins, in the kind of mid to high 50s. That seems pretty darn good. That seems like if they wanted to, they really could go into a significant kind of pricing war here. Is that something that McDonald's thinks about, or they just don't even want to get into that game?
Well, listen, I mean, McDonald's is heavily franchised, and so they're going to have stronger gross and operating margins than some of their competitors. So what we'll look at more is the restaurant level margin, and theirs is good. It's not like leaps and bounds better than the competition. That's more like a Shake Shack or a Chipotle. The fast casual chains tend to have that have stronger margins and on that end, but McDonald's, they do almost 3 million a store, and so they have wider restaurant margins, wider margins for their franchisees than a Wendy's, a Jack in the Box, and Sonic. And they leaned heavily into discounting and during the Great Recession, and it enabled them to take share. They massively outperformed their smaller competitors. So they're moving towards this, right? They want to establish that dominance in the industry, but they have to weigh the franchisee earnings with that, right? Because if they suggest a $5 meal deal and the franchisees say, I can't make money off this, I'm not going to run it, well, then it's not going to happen, right?
So does that put Burger King in like a better spot since they have less franchisees? Am I making that up?
No, Burger King is also, most of the quick service chains are very heavily franchised. Okay. It's pretty easy operations. It's easy to train new employees, and so they're typically very heavily franchised. Burger King's in a better position this year just because they're lapping a few years of very weak results. So that's where I think Burger King's advantage comes in. It's just weaker year-over-year comparisons, and management has injected billions of dollars into that franchise system, right? And so They're renovating stores, remodeling stores. They're marketing a lot heavier, and so those are all benefits for Burger King, and it could be hurting McDonald's a little bit here, but you know, McDonald's is the 800-pound gorilla.
Mm-hmm.
They have top-notch marketing program, right? Like I said at the top, they can offer prices that even Burger King can't match, and so that's why we're seeing kind of what we're seeing, right? It's a weak consumer environment, and McDonald's wants
Mike,
to keep and grow their share.
If a consumer's not going to fast food restaurants, what is the consumer eating? Are they just staying home and cooking at home?
I think on the low end, that's what we're seeing. Yeah. It is a K-shaped recovery. Higher income people are doing better. We're seeing stock markets, U.S. stock markets at all-time highs, Bitcoin near an all-time high, home prices remain elevated, right? And so higher income consumers are still doing pretty good. But even that cohort is showing some weakness, and they're kind of trading down into the QSR, cheaper occasions, and we're seeing low income consumers fall out. But so we're seeing guest check averages rise, but we're traffic is definitely down.
Mm-hmm.
Like I mentioned, it's low income consumers are about a third of traffic. So chains kind of have to try to balance it, right? Like they want to have value for their low-income consumers. They want to offer higher-priced items to kind of attract some higher-income consumers. And what we've seen is the chains like McDonald's and Jack in the Box that have been able to draw in the high-income consumers, Chipotle is another one, have outperformed their peers since the start of the pandemic.
And I should point out to just take a look at Kroger's results, right? Like comp sales rose just 0.5% last quarter. So yes, it topped analysts what they expected, but growth has really stalled. I mean, you got business normalizing and you got really high inflation, and it's a cloudy picture. So even the solution of just buying and cooking at home can be pretty rough. Hey, Michael, thanks a lot. Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst, who I think is deep tease here, everyone. Back with us on Monday.
In studio.
So
he finally found his train ticket, which he had lost for several years.
I mean, it's hard to find, to be sure.
Find his way back to New York.
And it's going to be about the back half for restaurants and quick service guys, and kind of who's winning and who's not, and how all that's going to wind up playing out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, joining us now is a very special guest. It's Thomas Healy, founder and CEO of Hyliion. Now, Hyliion is quite interesting because I covered this company a few years ago when it was a long-haul EV trucking company. They had a powertrain that they were calling the Hypertruck ERX, and it was going to be an EV trucker, and it seemed like it had a lot of legs, it had a lot of interest, and then the company pivoted instead to become basically a power generation company. And it's a really interesting pivot. Yes, there's some similarities, but a really interesting pivot nonetheless. And Thomas joins us now. What's happened in the last few years? Tell me about your business shift.
Well, Alex, you outlined it perfectly. So, the last handful of years, there's been so much momentum behind EV, specifically in the trucking space. But the reality is, over the last 12, 18 months, we've seen a continued decline to the point of many of the companies in the space are facing bankruptcy or have already filed for bankruptcy. They can't raise additional cash. And so we were in a unique position where we still had a strong balance sheet. We had about $300 million of cash on our balance sheet starting at the beginning of this year. And we had a unique technology in-house as well that is a generator, basically a mini power plant that can be deployed outside of commercial buildings, data centers, EV charging sites. And so we saw that it was best to pivot the company to focus on that and actually move out of that EV semi-truck space.
All right, so you have this Carno platform. Tell us about that.
Yeah, so think of it as, a power plant that's the size of like the bed of a pickup truck almost. It can produce 200 kilowatts of power, and it's designed to be able to be stacked together. So if you think of an EV charging site, you're maybe going to need a couple of megawatts of power, so maybe 10 Carno generators. Or if you think of a data center, you maybe need 40 megawatts of power. But if you then go to the other end of the extreme, you think of like a commercial like store, like a Walmart or a place like that, you're going to need about that 200 kilowatts of power size. So our thought is you come in and you actually make this generator your primary power source. So you remove your dependency from the grid. You can actually make electricity cheaper with this genset than most electricity costs out there. And now you kind of have this model where you now make power outside your building, and you use the grid as your backup power supply.
So the two things kind of relate together, is that what was wrong with the EV trucking part? Was it that it was too expensive to build at scale, or was the demand not there?
Yeah, so 5 years ago, fleets were saying they're going to buy EV trucks in mass volume, and that, by this time, most trucks being sold were going to be EVs. The reality is EV adoption has gone extremely slow, and fleets are saying, we're going to buy onesie, twosie, try them for a little while, maybe we'll buy more. But what's really happened is people are waiting until the government mandates that EVs need to be adopted, and we're seeing those dates continue to get pushed out to the right. And in addition to what you mentioned of the cost of EV trucks have continued to go up as well. So we're really just seeing this situation where adoption isn't happening anywhere near the rate that was initially expected. And so being in the public markets, the companies needing to raise more cash and stock prices continue to decline, we just thought it was best to get out of that space and focus on an area where there's actually a lot of momentum, right? We talk about AI, that needs a lot of power generation.
So what can you take from the EV trucking to the power world? Like, how were some things transferable?
Yeah, so this generator, the Carno, was actually something we acquired out of GE, and it had been a project that we were working on with General Electric for a few years, where we were actually going to put it as the generator inside the truck to charge the batteries while you were driving. And so we acquired it out of GE a couple of years ago, and we always saw it as a solution initially for trucks, but we could go into the power generation space. But as we've kind of seen the market shift, we saw that just going after power generation and stationary power first made a lot of sense. And then it's still a technology that we see could be viable for the EV trucking space down the road.
Talk to us about, again, on this new energy platform that you have. Where are you in terms of in your timeline of deploying these, making sales? Who do you target to sell to, that type of thing? Where are you in development there?
Yeah, so we're at a point where later this year we'll actually be getting units out into customers' hands. So it's been a north of 5-year development program, both when it was in GE and now at Hyliion. And so we're right on the cusp of just about to start getting units out there to customers. A few key markets we're going after. One is that EV charging space. Another is actually using waste gas. So if you think about like oil and gas sites, they flare a lot of gas right now. The Carno generator can actually be a great way to take that gas and make electricity out of it. We're going after commercial applications like data centers, commercial warehouses, hotels, hospitals, those type of applications. And then another one which is kind of unique is actually the marine space, so powering ships and vessels off of this genset as well. One of the unique things with it that we haven't talked about is it's a fuel agnostic solution. So it can run on futuristic fuels like hydrogen, like ammonia, but can also run today on fuels like natural gas and diesel and propane. And so for customers, you're kind of getting this like future-proof solution.
That's interesting. So it is transferable. What is the demand like?
Yeah, so power generation demand is very strong right now. I mean, just to share an example with you, like we obviously knew the EV trucking space well. When people would go talk to their utilities about getting a grid interconnect, trying to get electricity for their chargers, they're being told it's like 2 to 3 years just to even get access to the power to get connected to the grid. And then in some instances, some parts of the country, they're just being told there just isn't enough power available at all. So, we see a few things happening where you've got EV charging, you've got AI for data centers, you've also got industrial applications moving over to electric. So the demand on the grid continues to increase, but we're also in a position where new power plants aren't being made and infrastructure isn't being upgraded at the rate that it needs to be. So that's where we're seeing the market really shift to these kind of distributed power generation models where you make your own electricity locally to power your facility as opposed to being reliant on the grid. And so, we see a massive shift happening to that sort of market over the next few years here. And it's already started, which is great to see.
So, I mean, you called out one of the big headwinds, I guess, facing the EV business today, at least here in the U.S., and that is whether the U.S. electrical grid can even support the transition to EVs. You're down in Texas. You guys have your own grid, but how about just the big picture? Can the U.S. grid support the transition to EVs?
I think it's going to be a tough one without this distributed power generation model. Just this morning in Texas, we had a power blip at this facility. I was on a call this morning with a colleague in Michigan. Her power was out. So, I mean, the reliability of the grid is a real problem right now. And one crazy stat is if you plugged in 10 semi-trucks into the grid, that would consume as much electricity as the entire Super Bowl stadium during game time. So
wow.
It's a crazy amount of power that these trucks will draw. And I don't think the grid's able to handle it today, at least not universally across the country. And if you do want to support that type of demand, you need not only the power plants, but then you need to go build transmission lines. You need to set up the local infrastructure. So it's kind of this ripple effect versus you could just put this generator down and start making your own electricity locally.
It's really interesting stuff. I wish you luck on this one. Let's check back in and see how it's going. I know that this is all a huge transition pretty much for everybody, and companies included. Thomas Healy joining us, founder and CEO of Hyliion, joining us. But it's so interesting, right? Because I just think his transition is so interesting because it's too hard.
Yeah.
EVs are too hard. If the demand's not there, how do you stay in business?
I don't know how you do it as a public company. I know the stock's been down, and they've been drawing down on their cash that they got from their IPO. I'm not sure if that was a SPAC or not back in the day, but that's kind of an interesting test case to see how a company, as a publicly traded company, can completely pivot the business that it's in.
And remember too, like Tesla, yes, it makes cars, but it's also a storage play.
Right.
Like it's also a battery storage company, and in which case you wonder like where the value of EVs actually is.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.